Let's do a very quick midweek market update to prepare for the remaining 2 trading days of this shortened holiday week. Welcome to the show, my name is Matt, and in today's episode, we'll specifically be covering the concept of the 3-bar play, since that's what's mostly been set up out there. Remember to check out the additional resources linked down below in the description, hit the thumbs up button, and subscribe before we get started, and stay tuned until the end of today's show. I've got one additional trade idea to share with you, which happens to be a 3-bar play that you won't want to miss. With that said, let's jump right into the SPY daily time frame chart and see what's going on here from a trend point of view. So this is the last major daily higher low that we have. This did not yield an hourly downtrend, nor did this consolidation up here. So at best on the daily time frame chart, these could be considered soft higher lows, but I wouldn't consider them concrete daily higher lows. Of course, we're sitting on the highest high in the trend cycle. It's a brand new all-time high. So the market can certainly afford some sort of daily higher low pullback, although there is no indication of a pullback looking imminent. So if the market did decide to turn around Thursday, maybe we get a daily higher low here over the top of the previous balance range. 3 days of balance breaking out on Monday. That level is 544, pretty straightforward. If the market breaks down beyond that, I would still make the argument you could find a daily higher low here at 537. Gap fill reversal, as well as the lower edge of the weekly expected move. Obviously, to get there, it would yield some sort of hourly downtrend, and from there, we could call that a concrete daily higher low from here to here, and we would look for the reversal back in the upward direction. So the downside, we'll talk about it because those are the reference points that we ultimately have here. But let's start to get into the 3-bar play setup, which is in force. So bar number 1 represents momentum in any particular direction. You have bullish 3-bar plays, bearish 3-bar plays. This one's obviously bullish. So move in the upward direction. That kicks off some momentum. Bar number 2 represents a pause or consolidation over the 50% mark at minimum of the momentum bar. In this case, this is actually bullish consolidation well within the upper third of that Monday range. So very, very bullish here on the daily time frame chart. It represents a very small pause from the buyers. So on the daily time frame chart, we're looking for follow through over those 2 equal highs into blue sky territories, and the upside really takes care of itself here at the all-time highs. It's whole and half dollars intraday levels that form. Now, if you're taking a swing approach to the market, I would really sort of encourage you to think about what's required if you're going to enter over those 2 equal highs and put a stop underneath the inside bar low. You've just defined your risk interval, right? You've really got to make it worth your time by fishing for at least a 2-to-1 here on the daily, which probably means that you're looking for 553.75 at minimum, 554 plus on the daily time frame chart. If you're uncomfortable with the idea of going long here at the all-time high, there's nothing wrong with that, right? This is definitely not the ideal time to be chasing longs after a breakout momentum move has happened. You've got to hold on to that 2-to-1 risk reward ratio if you're going to take the long, and you've got to identify, okay, I'm sort of late to the party. Obviously, the market has moved substantially off of those lows. You have to be comfortable with that fact. So then the next question becomes, all right, if we're not really looking to execute that on the daily/swing time frame perspective, how can we bring that on down to the hourly time frame chart and execute based on that idea on a smaller time frame? So very, very straightforward. On the hourly time frame chart, you could think of this as a micro consolidation, right? All a 3-bar play is a higher time frame pause representing a smaller time frame bull flag in this case, right? On the hourly, I think we can all agree that this is pretty textbook bull flag consolidation. If we break out through the bull flag highs, retest the flag highs or the breakout point, great. On the hourly time frame chart, you can reduce your risk not wanting to get caught in a failed breakout by putting a stop underneath that breakout point, and then, all of a sudden aiming for a 2-to-1 risk reward ratio now just means looking for 550.75 instead of 554, 553.75. You've reduced the amount of, follow through to the upside that you're sort of asking for from the market. Now, it doesn't mean that the setup has to play out, right? Let's be very clear about this. Just because the market is suggesting this setup does not mean that there is a guarantee we break out, get a retest that's clean, and then some sort of follow through to give us the 2-to-1 risk reward ratio. If that was the case, then everybody would just, algorithmically program this trade and execute on it every single time. So we still have to take the discretion of saying on the hourly chart, if we get the breakout, is there a 5-minute double bottom here? Is there a 5-minute inverted head and shoulders on the retest? Is there a hammer candle? Is there some sort of indication that gets us interested in buyers stepping up over the breakout point? Because the hourly trend at that point does what, right? You have lows, higher lows, big time hourly higher lows. Along the way, you had highs, higher highs equal highs. You've achieved a higher high based on the breakout. This would be your next hourly higher low, being respectful and staying over the top of the consolidation, right? So that's what we're looking for in the upward direction. If you're trying to trade this as a pure play, bullish 3-bar play from the daily, looking to execute on the hourly and 5-minute. Now, you might bring up the fact, okay, Matt, what if this fails? What if we actually open inside the consolidation? What if we break down from the consolidation? All very reasonable points, right? A couple of things I want to lay the groundwork for before we talk about shorts and pullbacks. Number one, what type of participants are active in this market over the last really 2-3 weeks at this point? It's been pullback buyers, dip buyers, and at this case, based on Monday's breakout, definitely momentum buyers involved as well. So that's point number one. Dip buyers and momentum buyers are active. Number two, do we have any indications of stronger sellers? To me, the answer is clearly no, but let's talk about why. On the Tuesday morning open, notice the hourly bars have, I wouldn't call them major and substantial upper wicks. It's not like we had one of these, but there are upper wicks there indicating some sort of struggle near the highs of the Monday breakout. Now, if we look at this low of Tuesday, it goes directly to the pullback low of the last hourly bar out of the Monday session. If we had stronger sellers entering this market after some struggle near those Monday highs, why was there no follow-through underneath these lows for a thin structure retracement? As we'll see on the market profile in just a moment, there's virtually no volume at price in some of these areas. So are stronger sellers here? The answer has to be no from me. So what does that leave us with in terms of pullback indications? If we were to open in range and break down, I would not be a short seller through the low on the initial move here, and instead I would want to see the confirmation of a lower high underneath the flag range for the rotation through the thin structure, and perhaps you can set up risk reward that looks something like this. A little bit of a stretch, the stop might have to be a little bit looser, maybe the entry's not as precise, it's down here. You get the concept though. You're aiming for a thin structure retracement, and then when we get to 544, based on what we just described from the daily time frame chart, certainly thinking about higher lows in this area. So say that the hourly breakdown occurs like this. Can we spot a double bottom? Can we spot an inverted head and shoulders reversal? Is there some sort of daily hammer that prints down here, or even just an hourly hammer with a really long lower wick suggesting that buyers are stepping up at that key structure? So I don't think we want to lose sight of the fact that the daily trend remains so firmly in the upward direction. You can take the scalp from point A to point B, but remember, you've got to spot the lower high underneath the bottom of the range. Now, why is that so critical here? Why have we spent so much time on that? Because you could easily see, remembering that dip buyers are really active in this market, you could see the market break down through these lows, and if you get the Brigade bolt, meaning that there is no attempt from sellers to produce a lower high underneath 547, the Brigade bolt suggests the higher low back inside of the Tuesday range. That's actually a long right here, and you have a failed breakdown from the sellers. I would assume that we're at least going for the all-time high test, if not blue sky territories, on some sort of breakout. So that's what you're trying to defend against by looking for the hourly lower high underneath 547. The last breakdown indication that I'll give you, which sort of flips this on its head, is the opposite, right? You start to get your bullish 3-bar play breakout, but instead of finding that higher low over 548.35, it's the exact opposite, right? So you fail back through. Now all of a sudden you have trapped buyers on the breakout, and nobody stepped up on the higher low over the top of the previous 2-day range. In this situation, I would be willing to, because you have two groups of disappointed longs now. Number one is the group of breakout buyers. Number two is all of this consolidation positions that were put on Tuesday. In this situation, I would be more open-minded to and willing to take a flush through this without waiting for the lower high under 547. And again, it's because you have two groups of disappointed longs overhead who will now be weighing on price in the downward direction. Okay, so that's how I'm attacking the market into the remainder of this week. Those are the primary thought processes that I have going on in my head right now. And primarily because the trend is up on the daily time frame chart, weekly time frame chart, this is very bullish consolidation. I'm primarily thinking about this, but open-minded to a failed break. If it wants to give me something that does this, maybe it's even a lower high here and then an equal low breakdown, I'm not going to shy away from that because of some of the bearish divergences that are still in play across the broad market. Now, I threw on the anchored VWAPs, but I do need to adjust this one here in real time. Let's bring that up to the 17th, aka Monday, just to reinforce the idea. Pretty spot on, right? That's going to be right there at 547 as and if we open up on Thursday, anywhere sort of in range or even above range. Futures are currently indicating above range is slightly more likely. If we bring out the Fibonacci's from the bottom of the Monday move up to the top of the Tuesday inside bar mostly, this is all happening over the 38.2, another bullish indication. So we're all good there in terms of confluence. Let's take a look at the market internals. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. A couple of reasons why I would be open-minded to the breakdown there and the pullback underneath the Tuesday low, right? Let's evaluate how strong the buyers were actually on Monday, right? So price action always rules all. Obviously, it was a strong move in the upward direction. But at the exchange level, how many stocks were actually participating in that? How was the breadth? Doesn't really look that great. Certainly not substantial reads up around 300 million. Tuesday's consolidation really gets the freebie pass, gets the hall pass. There's not much going on here. We were sideways anyways. Not concerned. It's bullish consolidation, positive volume flows. Advanced decline line is positive. But Monday, we travel from negative to positive. It's not like we were anywhere close to trend higher zone on that day. Tuesday, I will point out as well that the index score was mildly negative. It's certainly not concerning down below in like trend lower zone, look out below, but it's something to again say, hey, we're not going to shy away from the short if it presents itself. Let's take a look at the cumulative builds out of the tick. Okay on Monday. I'm certainly not going to sit here and argue that this is strong. These are loosely 1,400 at the peak of each day, both Monday and Tuesday. Remember, substantial reads on the cumulative are 5,000, net positive or negative. We're just not all the way there on Monday, of course. So again, not shying away from the short, but please make sure it comes from something underneath the low of that Tuesday session to aggressively rotate through some of this thin structure. If we're over Tuesday's low, I don't think that shorts should be the consideration at that point. Let's briefly take a look over at the market profile. That's going to be this tab here. If you're not familiar with this screen, here's another video tutorial in the top right-hand corner. Let's keep it simple. So value area and point of control on Monday certainly shifted higher in the overall profile. I mean, it was not like point of control was left at the lows of the session, value was towards the midpoint. No, straight to the highs, which would indicate bullish acceptance near those highs, people willing to transact and do business here. If you look at the inside bar from Tuesday, value is completely contained within range. Point of control mildly moves to the downside, but nothing concerning. Again, this is high and tight consolidation, technically more indicative of bullish activity. I will also point out here that we have a poor high on Monday and a poor high on Tuesday. So in theory, if the market tests those in the regular trading hours, we should look for a break through that to repair the structure, and then it becomes all about finding that hourly high or low we were just describing to trigger the 3-bar play. So I like that. It's mechanical. They're back-to-back. They're very equal. Value is certainly higher. The next thing to talk about is the thin structure underneath us, and we were sort of alluding to this on the daily and hourly time frame charts. Notice D period looks into the single prints below the M period overlap from I, and you can see the volume taper as well in the volume profile. Here's that fat volume profile, tapers to basically nothing. Was there any acceleration in D period through some of the other thin structure that we have down below? The answer again is no. So if I'm thinking about who's participating in the market, it's still not stronger sellers. We're not seeing any indication of stronger sellers stepping up. Now, on the SPY hourly time frame chart, we talked about the fake breakdown situation. And I want to give you a couple of reference points here on the ES to determine that. If we close the single prints from H period down to about 55.35, and you notice the market starts finding buyers around this area, that to me would be a great indication that it's likely going to be a failure from the sellers to move lower. We're finding support over again, on a relative basis, a higher volume node relative to the thin volume structure that's overhead if we're supporting, once again, 55.35. I'll give you the SPY cash equivalents in just a second. The next one is this F period single print down here. You can clearly see, let's just use round numbers, 55.25 and 55.15. If the market's supporting over 55.25 and unable to poke into this thin structure, do we have stronger sellers? The answer from me has to continue to be no. Now, if there are just aggressive breakdowns on high tempo, meaning the speed of the tape is very fast, then fine. Like these levels, if we're testing this, again, let's say that we come down hard and fast and we stop right at the top of the singles and just put in bearish consolidation on like a 5-minute chart and then start to nudge into the singles. If the tempo was fast here, I would probably expect these singles to break and close. If you're quick draw McGraw and you want to try to pull off a short there, that's fine, but just understand that that trade is not for the faint of heart, right? So that's what we've got out of the market profile here. Let's do a speed round through the QQQ nasty NASDAQ. What do we see on the daily time frame chart? A lot of the overlap here is really going to take care of itself. So obviously, blue sky breakout, uptrend in force on the daily time frame chart. Daily higher lows can be found here. Daily higher lows can go gap fill reversal. Hate to be that guy, but we don't have any hourly downtrends here or here. So in theory, it would be deep and it would be uncomfortable, but a higher low could be found anywhere really over 459.25 on the daily time frame. The 3-bar play is in effect up here, so let's take it on down to the hourly time frame chart. You can see all of the same indications. A couple of differences here out of the NASDAQ I think that are worth pointing out. If we quickly take a look at the Tuesday low of day, where did that land in relationship to the Monday afternoon pullback? Here's the Monday low. Notice that we break down under that low on Tuesday, find support off of the anchored view app from the Monday open, and then close back within the Monday range. So again, stronger sellers here? Absolutely not. Bullish consolidation in the range, breaks higher lows over 486.75, blue sky territories, bullish 3-bar play breakout. If we break, fail, and then come in for some sort of breakdown here, great, you can take the short because now you have trapped breakout buyers and overhead supply from the consolidation. If we open in the consolidation and breakdown, it's not a first test breakdown, it's a lower high underneath at 484, then a thin structure retracement. First target would be down below 477.85, and again, the Brigade bolt will also play if it unfolds that way on some sort of higher low above. And again, you've got to spot the lower high indication on a 5, 15-minute chart, an hourly lower high. Something at 484 needs to keep you below that level if the short's going to play from point A to point B. If there is no indication of sellers there, I would totally flip the script and say, okay, dip buyers have been rewarded. How can we get involved on this higher low back over 484? Let's move it on down to the NASDAQ internals here. Same indications, pretty weak on Monday, not really suggesting the strength of that breakout was really there at the exchange level. We've talked about concentration risks, Microsoft, Apple, NVIDIA. We know this stuff. Notice the consolidation on Tuesday, a little bit weaker than the S&P. Breadth was pretty much flat that day. Cumulative tick is also flat here. A little bit more of a severe negative build on Monday, not really recovering to positive into that afternoon either. If we take a look at the market profile for the NASDAQ 100, what do we see over here? A lot of the same indications. You're still getting the inside bar in the upper third of the range. Also notice the D period pullback closes the H period single prints here, and we did close back inside of the M period, right? If we did something that looks like this, we closed back above on that Tuesday session. So sellers, I mean, they pushed it through the thin structure. There was that retracement, but buyers stepped right up at a key inflection point out of the market profile. So this to me is making sense, and again, aligns with everything we've been discussing so far, that buyers remain in control. The point of control is higher on Monday, value area is higher, pretty inside value on the Tuesday session. We don't have poor highs on the Monday or Tuesday out of the NASDAQ, so carry that forward, that these levels might not be as receptive to a possible break through them as cleanly as the ES and the S&P 500. Let's move back on over to the platform here. Let's finish up the broad market with the IWM and see what's going on in the Rusty Russell. Let's go back to a daily chart here, IWM. And of course, it continues to be the problem child. One of these things is not like the other. It's obviously not trading anywhere close to all-time highs, but more importantly than that, it's just not even close to a pivot high, a swing high, nothing. As a matter of fact, it's actually suggesting a lower high underneath a previous balance range on the daily. It's got a rejection of the daily 50 SMA. We did not close an inside bar here. It actually looked over the Monday high and failed to close back inside of the Monday range. So this is not a bullish 3-bar play setup. And as a matter of fact, a test underneath the weekly line in the sand is a breakdown of the Tuesday low. And that's just a very classic indication for a daily lower high, right? You have highs, lower highs. If this is a lower high after an inverted hammer, which is clearly showing us some rejections at the bottom end of the balance, short underneath the inverted hammer low, targeting the equal low, if not lows down here from a swing perspective, that makes quite a bit of sense. And remember that the concern really emerges on the weekly time frame chart, failing back down inside of this multi-year balance range and really starting to suggest that, hey, the head and shoulders, it's in force. And as we start to approach that neckline, look out below. Things could get pretty hairy here in the IWM. Let's move it on down to the hourly time frame chart, see what other types of nuances we can get here. So, you might make the argument, oh, look, Matt, dip buyers are stepping up out of the Russell. I wouldn't call it that. I would say that this was a pretty severely, oversold reaction to the downside, and you're just getting a counter trend move here, setting up a clean lower high up against the bottom end of that overhead supply daily 50 SMA that we were just talking about. This is not dip buyers stepping up. This to me is oversold, big move to the downside, getting a little bit of reprieve at this point, but still not like this counter trend move does not have the opportunity to change the daily trend or even the hourly trend at this point, coming off of the lowest low in the trend count. The other thing that we could do is bring out the Fibonacci's from the top of the gap up from last week all the way down to the lows. And, it's not perfect, but the 38.2 would technically indicate bearish consolidation in this zone. You can see that's where we've closed on Tuesday, rejecting that upper wick, rejecting this area for the daily lower high, 50 SMA, all those things that we just discussed at 202. I'd say the biggest failure of the small caps at this point is the lack of any attempt at higher lows stepping up on this massive gap up from CPI and, of course, the FOMC breakdown, right? In theory, this move to the upside, great. If it could have yielded consolidation up here, changing tone on small caps, looking for some sort of follow through to the upside. Hey, let's go for a partial gap fill reversal off of this previous structure at 203.25. Awesome. Changing tone. We have lows, higher lows. Maybe we can battle back up to the equal highs and threaten some sort of breakout. Obviously, none of this stuff took place. Nobody is interested in owning small caps on that move higher. So to me, this is the biggest headwind that I can see for the S&P 500 being a risk-off indication, as a matter of fact. Let's bring out those studies and just see what's going on from an intraday anchored VWAP perspective. And again, this huge cluster, just heavy overhead at 202. So we know the threats here out of the IWM as a bellwether gauge for the broad market. If we are underneath 202, I'd be very open-minded to trying to find shorts in the S&P 500 if we're breaking down underneath Tuesday's lows, right? That's the main takeaway here out of the small caps. Let's briefly glance at the internals. Again, mild, really just a counter trend move out of the futures, counter trend move here. This is not suggestive of stronger buyers stepping up and making an exchange level change. Not that the Russell is an exchange, but you get the concept, the full breadth of the Russell as an index. You're not really seeing index level change, on this counter trend move. It's just not supportive of any stronger follow through in that upward direction. Let's finish up the broad market here for the Russell with the market not the market internals, rather the market profile. So, value is higher. It's definitely higher here on Tuesday as well. Point of control drifts slightly in the upward direction. Notice the great excess in F period. J period has some decent excess. I think it becomes pretty clear if you're underneath Tuesday's low, you're also starting to fall through some of the thin structure from that Monday, counter trend move. You can see that the bulk of the volume was transacted up here. Anything that's underneath, 2042 in the Russell futures, it's sort of, not single prints exactly, but still thin structure volume-wise relative to the commitment up here at the highs. You could think of it like this. All of these traders, if they're trying to spot a Russell and small cap reversal, they're all wrong. That's going to act as overhead supply if we're underneath 2042, right? Let's get back on over to the platform here and quickly take a brief glance through the sectors. We'll do a quick run through of everything that's important here, then we'll get you on your way for that singular trade idea and onward. So weekly performance so far is looking more risk on than risk off. You have semiconductors leading, followed by industrials, about 8.3 something or other percent of the S&P, and then financials. I think that this is really worth talking about. Financials moving up the list here. We remember that they were the laggard last week, so if there is going to be some sort of sector rotation, I do like the fact that financials are starting to play catch up, meaning that if the XLK was going to see a bit more of a meaningful pullback, or even if it just cools off and goes sideways, if financials play nicely, that rotation is definitely going to keep your S&P 500 more bullish than bearish. At the bottom end of the barrel, the only red name for the 2 days that have traded so far is the XLU. Utilities down about 53 basis points on the week. What do we know? Very lightweight and D for defensive sector. If anything's going to be sort of weak here on this push to new all-time highs in the rally from Monday, it's exactly what you want to see. Let's briefly check in on the structural charts. No issues out of the semiconductors. Plenty of opportunities for higher lows here and here that would align with the bullish stance we have on the daily chart for the S&P as well. If it does continue in the upward direction, I think it's pretty self-explanatory. One of the things to be mindful of is that you've already seen a gap fill reversal and day two follow through to the upside. So are you pushing it here, looking for that continuation in terms of percent probabilities of unfolding? I would tend to think yes, but that doesn't mean short. It just means dial back expectations of follow through in the upward direction, right? Next up, industrials. Any bearish patterns unfolding here? Nope. As a matter of fact, we have a look below and fail from the Friday of last week. Target technically is the top end of the range. Obviously, that's bullish pressure for the market. Here's the XLF. I like the fact that we're supporting here, but we're not out of the woods. One of the things that we need to see is acceptance over the right shoulder. There's your head and shoulders. There's sort of your breakdown through the neckline. This still has the opportunity for a potential lower high. I'd like to see consolidation here and at least some sort of higher high over this set back into 42. That would be ideal out of financials. So watching that into the remainder of this week. If you find it trading back down at 40.45, I would sort of start to think, okay, buckle up, maybe start looking out for more intentionally the short in the S&P 500. Next up, XLY. Nothing but bullish things to say about this. Lows, higher lows, love the hold of the daily 50 SMA. Bullish 3-bar play is in force, looking for follow through in the upward direction. I mean, you've got the break, you've got the recapture of this inflection point, right? Remember, double top neckline, bottom end of the balance, higher low. It looks good. This to me is starting to become a little bit more helpful for the S&P. I wish it would just get in gear a little bit more and make a new pivot high over what we had from in the past there. Next up, XLP. Anything bearish to say? No. Midpoint of the balance range, lightweight sector, D for defensive, not concerned. Next up, XLK, almost a mirror image of that SMH, and just like the QQQ, higher low, gap fill reversal, all the way down to about 217.65 is a daily higher low, and even beyond that, weekly higher low. Again, not that this wouldn't be painful intra-week, intra-day, but 212 still keeps the structure alive for weekly bulls to say lows, and potentially higher lows here. So bullish 3-bar play is in force. We're looking for the follow through to the upside. We've got a little bit of a pause here, unlike the semiconductors, which got continuation on Tuesday. If this breaks out to the upside, that of course is going to be helpful for your S&Ps resolving the 3-bar higher as well. We talked about the spiders. Here's the TLT breaking the resistance trend line, but underperforming the TLT on the week, the S&P on the week so far. Remember on Saturday, we talked about the massive outperformance last week. That's been dialed back a little bit here. We'd like to see it continue to underperform the S&Ps to avoid a flight to safety style low. The XLB is the worst looking sector of them all, but am I concerned with that? No, it's such a lightweight sector. It does not have any meaningful pull for the S&P 500. So yes, weekly lower high. Yes, weekly double top. If you break the neckline, I've got to admit it will be slight bearish pressure for the market, but it's an inconsequential piece of the S&P 500. This is not going to crash the market unless it's also happening with semis aggressively pulling back, financials breaking down, discretionary. Like, you need the breakdown in the heavy hitters. This is, it's going to be nothing if this breaks down and everything else remains bullish. So not as concerned. Energy, not really seeing the counter trend resolution off of this 87.15, which I think it's bound to come around the corner in my view because of what's happening over here in crude. If you take a look, there's been a pretty severe reversal out of crude off of these lows. You could start to imagine, right, weekly inverted head and shoulders. We're over the neckline in here, about like 79.80 a barrel. So I would tend to think the energy sector is not going to continue in the downward direction, but we'll see. As of right now, I like that crude is doing this because of what it implies for global demand in terms of oil, obviously. Let's move along to the XLV healthcare sector. No comment on this one. Bulls and bears both happy up here. Real estate, lightweight sector, over the big inflection point at 37.70, not a big concern. Communications, pulling back, but from what? Obviously a higher high in the trend count. We know that daily higher lows can happen here, so not concerned with this. And remember, communications are a bit more of a risk-on style sector, and utilities, bottom end of the barrel, have triggered the double top. There's your neckline. We've broken down underneath. So next watch is just a lower high underneath 70, sustains a daily downtrend, and utilities continue to pull back, which, as we know, is fine. This is also a really lightweight sector that's not going to drag the market down all by itself. Let's take a look at the ratio grid just to understand, again, some of the concentration right now in the tech sector. We know that this has been massively outperforming. No surprises over here. It really boils down to the XLF becoming that yellow flag, white flag, if you will. If there is a rotation, if this pulls back, this needs to rally. You can't have these two things being this divergent and all of a sudden a pullback in tech. Otherwise, it's going to wreak havoc on the market. So if you're looking for an indication to short the market, it would be the XLK relative to the S&P pulls back, and financials do not tick in the upward direction here relative to the S&P. We know that this is the case because this is not helpful. This is not helpful out of communications. Industrial is not really helpful over here. Now, we need to caveat it by saying, okay, it's not looking great. There's really only one sector that's propping up the market. And again, this is that whole concept of concentration risk. But are we in a risk-off environment? No and no. If we look at some specialized ratios, so here's tech relative to government-backed bonds, absolutely not flight to safety. If we look at tech relative to utilities, no flight to safety there. If we look at apples to apples, I would still make the argument that there's not a flight to safety here. I mean, it has been in a little bit of a downtrend, but for the most part, we have not made big new pivot lows underneath. Again, the level's arbitrary here, but 2.23, as long as we're inside of this box, I would still make the argument that buyers are probably still in control risk appetite wise across the sectors. If that does make a new swing low, obviously concerning, right? Let's go with semiconductors versus healthcare. And obviously this also is a risk on indication. Let's take a look at the Dixie. This is where we have some of those divergences still playing out. So remember, the bearish divergences that we're going to discuss in this segment and onward really just suggest that it would be okay to consider a pullback short in the S&P. It doesn't mean go out there and short it at the all-time high. It doesn't mean be skeptical. It doesn't mean just second mortgage the house and go all in on puts as soon as Thursday opens up at 9:30. It means if you can spot the structural setup, I would be willing to entertain it because of these bearish divergences. So, number one, dollar higher, market higher. Typically, those two things do not belong in the same sentence. So, bit of a bearish divergence here. And that, of course, has a lot to do with interest rates moving in the downward direction. We can check in on gold just as a quick little heads up for the dollar, right? If this breaks out, in theory, that could alleviate pressure on the dollar, which therefore would continue the market rally in the upward direction. If the gold contract here really breaks down more aggressively underneath 2,300, I would look for the dollar to continue its escapade in the upward direction, possibly continuing the bearish divergence that we were just mentioning. Let's move on over to interest rates, though. In theory, this is going to be helpful to continue to propel the market in the upward direction. We know that there's this sick and twisted obsession the market has with rate cuts. Look at the possibility of a lower high underneath the long-standing inflection point on Tuesday, right? Bearish engulfer to the downside, headed for those equal lows, 43.33. As long as we're below, in theory, that's going to alleviate pressure in the small caps. Even though we're not directly seeing the trend change there, the more time rates spend at a lower level, the better that will be for small caps. Now, the worst thing you would want is just rates, collapsing, falling off of a cliff in 2 days, breaking down aggressively. What's that an indication of? Hint, hint, recession. Fed probably is emergency intervening, right? We can check in a little bit more explicitly on the Fed via the inverted ZT, basically the 2-year yield, right? And this is moving in the downward direction. We're still forecasting 2 rate cuts in 2024 for the end of the year. The Fed has come out in the S&P and said, nope, you're only going to get 1. Neil Kashkari has said something like 1 as well in the December timeframe. So market's still a little bit more optimistic than the Fed, perhaps. We're not going to jump on into the fundamentals for today's episode. So let's just move directly into the TLT relative to the S&P. We already talked about the chart, but this is still continuing to flatten out down here. You do have this series of higher lows. If you break out to a higher high, flight to safety becomes, again, a little bit more of a discussion point, not enough to just blatantly short the S&Ps, but a discussion point worth including in the narrative. Let's take a look at bonds relative to each other. And of course, these downtrends represent duration risk increasing for risk appetite in equities, right? So this is bullish here, those downtrends in bonds. If we look at credit spreads, minor uptick in the longer dated credit spread here. The shorter dated actually had a downtick. So there's a little bit of a divergence in the actual sort of instrument itself, but not really at a concerning point. Remember this April pullback, which felt really nasty? The grand scheme of things, it was like a 5%, 6% pullback, tends to happen once, twice, 3 times a year. Not the end of the world, and credit spreads were way up here. So we're not even close out of short term, medium term, getting there. But if those break out, then I would start to say, okay, hang on a second, what's going on? Why is this so divergent and the market continues to push for new higher highs? That wouldn't really add up. But so far, so good. We are still contained underneath the prior highs. HYG in isolation continues to be divergent. If we just zoom in on a smaller segment of these charts to evaluate, notice that you have yourself big time higher highs and the HYG junk bonds lower highs. So this again is another bearish divergence that we're going to put in our back pocket. It means that we can look for if the structure permits a bearish setup, but we're not really, not flying short here at the all-time high if the momentum is clearly up. Bitcoin, inside the range, not much to describe over there. New highs versus lows. We know that breadth isn't that great. Nothing really new to unveil over here. Starting to get positive again, but this is not how this should look as the market's breaking to new all-time highs. I do want to reinforce the SPX A200R, staying well above the 50% mark, not aggressively breaking down. This basically indicates that longer run uptrends are still in force and markets are not completely rolling over underneath daily 200 SMAs. If you take a look at the SPX A50R, right towards the 50% mark. So it's about half and half of the stocks in the S&P are above or below the 50 SMA, which obviously is a shorter look back period. So if you compare these two things, mild pullbacks have taken place across the exchange, across the index, I should more appropriately say. But it's not like, 30% of stocks are above the 200 SMA and 70% of stocks are below. If that was the case, okay, massive red flag. What the heck is going on here, right? Not the case as of right now. Let's move into the RSP. I will say that I like the hold of this level here at 163.60s as long as we're above. Again, it doesn't seem to me that it's a huge short in the market. If we look at the QQQE, even better, you've basically made it back up to the equal highs here as you're breaking out to new higher highs. So it's not like we have a bearish divergence in terms of direction and a larger breakdown here as this is going in the upward direction. We talked about this in the morning show. You guys can let me know in the comment section. Dow Industrials versus transports. I think that we'll just start including this only when the transports make a large outsized move. We know that this has been divergent, but it's not really been all that informative for a long while now, at least to trade the S&P or the NASDAQ. So let me know your thoughts down below. We'll move on into volatility. It remains floored. The meme going around online right now is that the VIX is going to zero, bro. Don't you know? So VVIX can be our heads up indicator. Is it anywhere close to like the volatility zone up here at 103? No. I mean, the complacency effect is in effect when we get down towards 75 like we were over here. I'd say that we're relatively low in the range, but it's not like we're slammed into 75 looking for the slightest little bit of uncomfortable activity to force volatility higher. Not the case. And we're through a majority of the catalysts at this point as well. If we're thinking about catalysts on the horizon, I mean, PCE, labor report comes out later in the month. The Fed is, going to send some speakers out as well. But other than that, not much in terms of large announcements. We're through earnings season, right? So volatility futures, strong contango, representing that money managers are willing to allocate capital in present conditions instead of the unknown future, instead of backwardation, where it's the opposite. Higher volatility now, lower volatility in the future. Money managers do not like that. So currently, this is comfortable for bulls in control. Same indication here. And the one-day VIX remains floored underneath 1275. No issues out of those charts. Let's briefly run through the core list of companies. So the concept of the 3-bar play should be top of mind as we're going through. Microsoft, what do we see? 3-bar play, upper 50%. Yeah, we're going to give it the benefit of the doubt based on the close from Tuesday's session. Definitely a red-bodied bar. Let's not ignore that. But any consolidation, really, I would argue, over the 3 equal highs at 443.15, it's nothing more than a constructive pullback into that level, looking for a rotation higher. Now, you'll notice that we have this level marked off at 447.75. If this is going to turn into an hourly double bottom, here's your Brigade bolt. You could probably even take the breakout through that level and trade back into the all-time high here, which is closer to 450.69. All right, so that is a possible indication early on for Thursday. If you can spot that, all-time high target, blue sky territories beyond that. If you're consolidating underneath, again, you're looking for this and the same reversal indications that we always talk about, inverted head and shoulders, hammers, the whole 9 yards, 443.15. Next up, Apple, what's going on? Daily time frame chart to begin. Daily bull flag, absolutely digesting a majority of this gain to the upside. If I were to, let's do it. Let's go through the exercise, right? Weekly time frame chart. If this bar closes up here, this is a weekly 3-bar play. What does that look like on the smaller time frame? It's the same concept of the daily 3-bar play looking like an hourly bull flag. The weekly 3-bar play looks like a daily bull flag, right? So everything's fractal here. Any consolidation, very straightforward, breaks up and over 219. Blue sky territories, $1.50. Willing to take some shorts underneath 212. We take a look back down at the hourly time frame chart. Notice the Tuesday breakdown did find acceptance underneath this 215. So I'm really eyeing the breakdown for the thin structure retracement if we can contain price activity underneath 215, looking for that sort of breakdown in there, right? So that, of course, would be bearish pressure for the S&Ps. Keep that in mind as you're looking for potentially breakdowns, right? If Apple, if Microsoft, if NVIDIA, if these names are breaking down, you really got to watch those as almost like a fourth market. Yeah, I guess fourth because the ES is in the bottom right, a fourth market internal, right? Next up, we've got NVIDIA. What's going on with NVDA, the one stock to rule them all? Tuesday breaking out in the upward direction, really fueling some of the fire higher, obviously. Very straightforward stuff. Either a pullback entry long over the all-time high 132.75, you get your Brigade bolt here, there it is, Or you could get a very nuanced, like 5-minute, 2-minute, 15-minute Brigade bolt up and over the previous all-time high. Remember, the name of the game at all-time highs is trying to trade in the direction of the trend, longing deep pullbacks into daily areas of support, or if you're trying to navigate directly on the all-time high, you've got to be able to manage your risk somewhere in here and pull off some sort of reasonable 2-to-1 expectation. You can't really say, okay, I'm going to long it here, put a stop loss underneath the breakout point as a day trader, right? And expect 2 times that in the upward direction. Not how it works, right? So that's NVIDIA. I would only change tone to being bearish if we're underneath the multi-day consolidation. That's 129.25. Next up, Google, sloppy, choppy, ugly, daily time frame chart, nothing to describe here. Balance range, yes. Better trades come out of this when and if we can clear this shelf, and that's going to be at 178.25 or to the down. Like, I'm not even in love to the downside short. Look at all the potential areas of support where buyers might step up. I don't love the structure here. The trend is certainly neutralizing. You could make the sort of stretch argument that this was a big failed breakout to all-time highs, lower highs in force, and you're basically aiming at equal lows down here. It's an idea, and I wouldn't say it's completely wrong, but I'm not thrilled about it personally. So for that reason, I'm going to move along to, of course, Amazon here. Nancy, what's going on? Daily time frame chart. I just realized we double-clicked, so we're on the hourly again. Let's go to the daily. Here we have it. Daily trend is pretty neutral, but I do like the concept of maybe some higher lows happening here near the daily 50 SMA. Lower wicks starting to emerge, hammer-esque bar on the Tuesday close. So obviously longs up and over 183.75, trying to navigate back up to these highs. That produces the daily higher low, right? And if we go on down to the hourly time frame chart, what would that emerge as? Maybe some sort of double bottom here. 1, 2 over the neckline. I would probably say that this can act as your inflection point. Again, 183.75. The reason being is because of the Tuesday opening sort of chop and slop around it. You can see we had a little bit of a hang up there. We even tried to consolidate above on the Monday session with no luck, right? So if we can get back above, I would tend to think that these sellers from Tuesday are second guessing the short opportunity here on Amazon, and it'd be more of a long. You could be patient. You could wait for the neckline break over that high. That's possible, but I think that this is still an early entry that's available. 183.75. Next up, Metaverse. What's going on with Zuckerberg's Fantasyland? I think it's a short. And this is the first change in tone that we've got out of the core list where I would say that the short is most attractive, right? So lower high happening here, underneath the top of the previous balance range. If we can spot lower highs up against 501.25, rotations to the bottom, and possibly even looking for continuation into 484.60 for daily higher lows near the gap fill reversal from this previous interaction over here. You've got the daily 50 SMA mixed in there as well. Here is the daily time frame chart. We're pulling back from the highest high, so pretty mild, in terms of bull flag consolidation. This is totally reasonable, looking for structure to support over the top end of the previous balance. So that's my take on Meta. I think that we have shorts available to get us into that zone, and when we get to the zone, that's where we change our tone. Next up, that was some pretty good rhyming, if I don't say so myself. Tesla. This is it's terrible. It's awful. It's not showing us anything with clarity. The only thing I will say about Tesla is that the weekly time frame chart is trying to show some early indications of like inverted head and shoulders. I would say on the weekly chart specifically, if you could recapture 198, 200 as a zone, maybe you could be optimistic and look for the rotation to the top end of this range. Again, optimistic, and we're not there yet. Obviously, this is a weekly chart, so that's more of a swing style approach. If we go back on down to the daily though, really choppy, really balanced, inside of range. You do technically have a bullish 3-bar play that's in force. So here it is on the hourly. If we could spot a higher low, hourly higher low, again, I want to be very, very explicit about this. Tesla's been the heartbreaker. So show me the hourly higher low, not just the 5 or 15-minute acceptance above. Show me the break. Show me the hourly higher low. Let buyers step up in here. Then maybe there's that rotation towards that loftier target on the daily at 198.85, 200, that zone that we were just describing, right? So you really got to prove it here out of Tesla. Other than that, I'm not thrilled about price activity in this box. Next up, JP Morgan. You color me impressed. I do like the move from Tuesday, but I don't think it's enough. I don't think it's enough for me currently to say it's time to throw shorts out the window, time for long. So this idea is that we have a balance range overhead, and this is still going to offer a potential lower high. You have highs, lower highs, lower highs, possibly still lower highs happening in this zone. If that's the case, then this wants to act as a double top underneath that neckline. The short is available through the thin structure rally from what was that? That's the Tuesday morning session into the sort of origin at 194.25. So shorts below 196, if you can spot the lower high, there you go, point A to point B. If you're just getting consolidation over 196, I don't think I would try to actively short it just based on the fact that this could emerge as cup and handle. You've got to be underneath this level to really, on the daily chart, continue to prove to me, sellers, right, that you're underneath this overhead range that's going to act as overhead supply. And then we could probably go out on a limb and start to suggest, okay, there it is. There's the patented Man Ray technology, the Man Ray pattern. It's trademarked, it's registered, it's copywritten. Don't steal it. We'll have the lawyers coming after you. But anyways, it's a double top, head and shoulders, starts to get a bit more dangerous there. And obviously, heaviest weight component in the XLF probably doesn't look great for the broad market. Here's Netflix. What do we see? Obviously, it's back on its grind mode, just getting totally in gear to the upside. I think that we're getting a little bit tired up here. The reason I say that is because look at the momentum, right? And then sideways, momentum slows down a little bit. The breakout's not as large. Sideways, momentum, it's more of a grind to the upside with some afternoon consolidation instead of a momentum breakout over a key level, right? So at this point, I think, a lot of those breaks have taken place. I do like the stair-stepping activity, so keep it simple. I wouldn't overcomplicate Netflix. If it's consolidating over 682.50, the all-time high is basically the target around 701. It was a penny shy at the all-time high, but that's the idea, right? Looking for that follow-through. If it drifts below, I would not be a short here. I would be a short underneath 674.75, looking for this. And as you can start to imagine, that might suggest some sort of head and shoulders, right? Next up, last but not least in the core list, we have AMD, and this did play underneath the breakdown point here. Lower high was offered. Very, very clean setup to the downside. Now, is it still a short on these lows? I would really encourage you to look back at the daily time frame chart and probably say, not thrilled about a short here. I would tend to think that coming into this congestion, there's the opportunity for some sort of buyers stepping up, offering a daily lower high, some sort of more constructive hourly uptrend that maybe does something that looks like this. Very, very, I would say ugly, to be quite frank with you, chart around this zone. So definitely giving the bears still the benefit of the doubt, but a new money short dead on the lows based on what's happened so far. Not thrilled coming into support. If there is going to be a larger breakdown, what I would prefer to see, honestly, is weak consolidation and then some sort of like break and subsequent. These are almost equal lows. That's really my hang up, I think, with AMD is that these lows are very precise. It's not like the sellers really got paid on that second breakdown here from Tuesday. So, some sort of consolidation that then sets up a balance, maybe a rinse and repeat, honestly, of this structure just happening over here, and then the breakdown into some of those daily levels at 146, daily 200 SMA as well. So that is AMD. The only time where I would change my tone is if this acts as a double bottom with the Brigade bolt over 158.25. You've really got to recapture that if you're going to sell me on any sort of long back in the upward direction. All right. One additional trade idea for you, and then we are on our way. Coinbase is actually the name of the game. And this is not a bullish 3-bar play, but a bearish 3-bar play in the midst of a double top, right? So we were talking about this trade to get back up to these levels. That's great. That played. But look at what's going on currently. 1, 2, both failing at 263. Back to the key neckline inflection point of the inverted head and shoulders, if you want to call it that. And notice the bearish inside bar from Tuesday's session. So inside of the Monday range, equal lows and closing weak on the lows. The upper wick is rejecting the 50% mark of the previous day's range. To me, the recipe is for an intraday breakdown into the daily 50 SMA. Now, it's not like a big home run grand slam style short, but we are looking for downside based on this evolution and based on this pattern. So on the hourly time frame chart, it starts to become clear as well. There's your double top. Here's your neckline. How do we get involved? Underneath the inside bar lows. So a couple of ways to actually trade this. Breaking the equal lows with sort of momentum underneath 237. If you want the actual lows, it's 234.75. Under 234.75, daily 50 SMA becomes a target. That's got to be a quick draw McGraw type trade. But then beyond that, really looking to stretch it into this at 220.50, right? And obviously your measured move from the head and shoulder, or sorry, not head and shoulders, but rather double top would put you beyond that. So that's a fairly conservative target. But remember, measured move is one thing, market structure is a totally different story. So that's really what I've got for you in today's probably not so abbreviated midweek market update. I always get lost in the timing of these things, but regardless, I hope you enjoyed the thorough look through of all the data points. I'll have to look back at how long the video ultimately is. And, maybe it's short, maybe it's long, but I hope to see you in the next one. As always, we will be live tomorrow morning, 8 o'clock for the pre-market prep. Remember that we have the unemployment claims, initial jobless claims. That might move the market a little bit, and we'll assess what's going on with our 3-bar plays across the market indexes, as well as checking in on all of the core list of components. So if you enjoyed the video, let me know down below in the comments section, not the description, the comments. Hit the thumbs up button, subscribe, all that good stuff. We'll hope to see you in the next one. Have a green trading week.